You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello and welcome to The Investor Way with myself, John McEwen, and my co-host Sam Ball. This week on The Investor Way, we have Burberry, SCS, Imperial Brands, Auction Technology Group, Britvic, and our US company of the week is PayPal. So I'll kick us off with the first on the list, Burberry, the fashion designer. They had their full year results out last week, with revenue rising 5% to £3.1 billion, reflecting like-for-like growth in all regions apart from the Americas. And the company has benefited from the relaxation of COVID restrictions, boosting sales in mainland China in the final quarter. The group also reported on an excellent response to the refreshed brand campaigns, and both leather and outwear performed strongly. The higher revenue fed into an 8% increase in underlying operating profit to £634 million, and the group has also focused on increasing efficiency in the supply chain, along with its merchandising and digital operations. Free cash flow rose to £393 million from £340 million, but net debt more than doubled to £460 million, reflecting the share buyback programme. The group remains on track to meet its medium-term guidance, including topping £4 billion worth of sales. Alongside these results, a dividend of 61p per share was announced, which represents a 30% increase. And the £400 million share buyback was also confirmed. In terms of valuation, Burberry has a market cap of £8.4 billion and trades at 19 times forward earnings, with a prospective dividend yield of 2.5%. I certainly didn't think these results were bad at all, and very encouraging with the reopening of China, although the market had been hoping for more growth and the shares certainly aren't cheap at the moment. I think one of the group's main strengths is having a luxury brand with pricing power that's so popular in Asia. I mean, that's been bad recently with the strict COVID policies in China, but is a long-term strength and the growing middle class over there. It's also not as expensive as some of its European and American peers, which again might attract people from a value perspective. In that sense, I think it's appealing. I'm not sure about the share buyback, but the debt's not all that high anyway. Historically, and sort of, I suppose, last 10 years, it hasn't really delivered despite having those fundamentals there. But I still think it is appealing and one for my watch list. Sam, what are your thoughts on these results and Burberry as a company?
I think they're all right. What I'm struggling to get my head around is I'm not sure how I'd expect it to perform in the current environment in terms of a luxury brand in what's basically a cost of living crisis. So I guess in that context, and this is speaking from a position of ignorance, but I guess a revenue rise of 5% is okay. And then the 8% increase in operating profit, I think that's decent. I'm not a huge fan of the buyback, but that's mainly just because if I was a shareholder, I'd rather see them just up the dividend. I don't think the stock is particularly cheap in the medium term. I think sales at 3.1 and they're targeting 4 billion of sales. I think if they're popular in Asia and China, I don't think that's unreasonable. But I don't know, they're quite modest targets, really. And considering it's at a forward PE of 19, I don't know, I do still think it's quite pricey. I just think, and as well, I think the brand is decent, but if I was buying, I'd rather have like Louis Vuitton or something. If I was going to own one of these luxury stocks, I probably wouldn't go for Burberry, although that is reflected in the valuations, I guess. But no, I think they're pretty decent results, but just I probably mixed feelings, I think.
Fine.
But it's all right.
It's all right. Okay. SCS.
Yes, so this is a debut on the show. It's also a small cap, actually. So their market cap is only 57 million. So this has come about because I recorded an interview with Ben Bennett, who, despite the name, is not a superhero. He is an investor. You remember the Brummy guy at the Fundsmith conference?
Yeah.
Yeah, it was him. So I recorded that last week. So that's just sat in the bank waiting to be released. But one of the companies in his portfolio, just to give you a little taster, is SCS. So I thought, well, we'll take a look at it. So I'm assuming everyone in the UK knows what SCS does. They are, well, basically the sofa retailer. So I wanted to have a look at it. Their last results actually came out at the end of March. Yeah, actually came out at the end of March, and they're for the period ended 28 January. So these results are a couple of months old, but I'm suspecting most of you don't follow SCS that regularly anyway, so they're probably new to us all. So I just wanted to have a little flavor, get a little flavor of the company. In terms of the results, gross sales for the half were 155 million, and that was up 5% on the year before. And revenue was 147.9 million, which was up 3.7% on the year before. Gross profit was 67.8 million, which is up 0.3% from the year before. And gross margin was down 1.3% to 43.8%. Loss before tax was down from 3.6 to 6.3 million. Loss per share was down from 7.6p to 14.6p, but the underlying loss per share was better, up from an 11.8p loss to a 10.8p loss. They've said that the underlying loss before tax was 900,000 ahead of the prior period and is typical of half one performance, which includes significant marketing expenditure to support the winter sale and where profitability is substantially weighted in the second half. If you look at the last results at any point in the last 5 years, I think the operating profits do reflect that. So they consistently have a loss in the first half, and then it looks like they make a decent profit in the second. So there's not really anything concerning about that. They've highlighted strong balance sheet with cash of 76.9 million, although that is down from 87.9 million in the half before. They've achieved market share gains in the period, and they've highlighted that they've exceeded 400,000 reviews on Trustpilot, making SCS the 5th most reviewed company in the UK. They've maintained the maximum 5-star excellent rating on Trustpilot, and they're the only company in the UK's top 10 most reviewed to hold that. They said like-for-like order intake momentum continued to improve in the period end, with growth of 5.7% in the 7 weeks to 18th of March 2023. They've highlighted the resilient balance sheet, which, as at 18th of March, had cash of 83 million. And they're pleased with the Snog acquisition, which they expect will be adding to earnings in the 2024 financial year. They intend to invest in the business throughout the second half and expect Snog will report a second half loss before tax of 1 million. In terms of what Ben said, I think really he basically said it's very, very cheap. And when you actually look at the figures, it's just sort of plugging along, selling sofas. It's doing all right, but it's mainly how cheap it was. He also highlighted that they've got more cash on the balance sheet than the market cap without really having much debt. So I did have a look at that, and it is true. But I think the reason why is, so I had a look, and it looks like the business model, SCS does not pay up front for its stock. So it collects the customer deposits, then orders the stock from the suppliers, and customers have to pay for the products before delivery. But SCS doesn't pay the suppliers until the end of the month following delivery. So they're always going to have a positive cash position. But if everything was settled, they would either have to buy the sofas first. So these are basically just customer deposits, really, that are sitting there. So, you know, if someone took the Ben Graham approach and the company was just liquidated, all that cash on the balance sheet wouldn't be going to shareholders. It would either be going back to the customers or it would be going to suppliers, or a lot of it would anyway. But if you look at the last 5 years of results, they were all right. So over the last 5 years, they've increased revenue from 333 to 344, so a tiny increase, an operating profit from 14 million to 20 million. They've got some interest of about £4 million a year, but consistently they are churning out decent profit before tax. Profit before tax has been fairly average, fairly consistent. It's been between 14 million and 23 million a year, with one loss in 2020, which was the COVID year, so we can let them off for that. In terms of the valuation, the business trades at a market cap of 57.38 million, so it's not big enough for the FTSE 350, and it has a dividend yield of 5.33% and a PE ratio of 4.56. So it is incredibly cheap. I'm not sure where some of those earnings are going, though, because I think they're pretty saturated, so I don't know why they're not paying out higher dividends. So it could be there's something in there that I'm missing. But in conclusion, I would agree that it's pretty cheap, but I think it's probably cheap for a reason. It's probably not going to grow very much, and it probably gets a bit more stick because it's a smaller market cap in not a particularly attractive industry. I suspect if it was a bit bigger and it was listed on the FTSE 350, you might be seeing it a PE of 7 or 8 instead, or something like that. But it is cheap. If you buy it at a PE of 4.56 now, in 5 years, you've basically got your money back in earnings, which is pretty decent, as long as you don't mind having not the most glamorous business in the world. And you'll be getting 5% dividends a year. It's all right. I can see the appeal of it, but for me, I just kind of think it's cheap because you're not going to get any growth. If the dividend yield was higher, if it was an 8, 9, 10% dividend, I might be more interested. But at 5.33%, I just think, well, I can get that in better quality stocks, or I have to pay a bit more, but I think I am generally getting a better business. John, what are your thoughts on these results and the valuation?
Yeah, I mean, I would largely echo what you said. It's certainly cheap, but I wouldn't really look further. I think there are much higher quality businesses. Yes, you have to pay more for them, but I think in the long run, that would pay off as a strategy and buying more quality and hopefully at a reasonable price. But I don't think you need to look right down there. And it's, I guess, likely to have a lot more volatility as well. But no, it wouldn't be the type of stock that I would go for personally.
No, I agree. It's just not for me. Some people might do very well in it, but I think with something like, if I had something like this, where it's such a small market cap, it's in such a difficult industry, and I know it's an all right business, but it's not the best business in the world. It's the kind of stock where it's kind of like every earnings report. I'm quite lazy with some of my earnings reports. I might not read them for like weeks or months, or I might get, an interim report might come out and I think, oh crap, I forgot to read the full year results.
Yeah.
And you sort of get away with that to a degree. And most of the time I do look at them at some point, but you get away with that to a degree when you're buying quality businesses. I would feel like I had to keep an eye on this, which I don't really want. It's just too much effort for me.
Yeah, sleepless nights.
Absolutely. Should we move on to what is probably a business that you don't need to keep an eye on much because you know exactly what the results are going to be before they come out?
Well, absolutely. So Imperial Brands, covered it lots of times on the show. The world's 4th largest tobacco company, 2nd largest in the UK. They had their half-year results out last week. And I mean, Sam, I don't know whether you've had a good read of them or whether you've just guessed what I'm about to say. But their half-year revenues dipped by 1% to £3.7 billion. And despite robust pricing, growth was held back by the exit from Russia. Excluding Russia, tobacco price mix was 6.8%, with 2.5% fall in volumes, but pricing adding 9.3%. Despite this, underlying operating profit for the first half was up very slightly by 0.8% at £1.7 billion, ignoring the effect of exchange rates. And tobacco volumes were down 12.7% with the exit from Russia. Net revenue from the next generation products was up 19.8%, with growth of 35% in Europe, helping offset declines in the USA. There was a free cash outflow of £432 million compared with an inflow of £336 million last year. But the company remains on track to deliver material inflows at the full year. Meanwhile, net debt rose from £9.8 billion to £10.2 billion, which is roughly 2.4 times EBITDA. The first half saw £500 million share buyback, with similar levels expected in the second half. And there was an interim dividend announced of 43.18 pence per share. The group's expecting an improvement in profitability in the second half as price increases taken in the first half take their full effect. In terms of valuation, Imperial Brands has a market cap of around £17 billion and trades at 6 times forward earnings, compared with a 10-year average of 10 and yields in the region of 8%. Like you said, Sam, pretty much what we've come to expect, particularly from Imperial Brands, but also it's not a dissimilar picture at British American Tobacco. And it was in line with market expectations. Shares didn't really react. Moderate volume declines with fewer sticks sold, but the price rises making up for that. Clearly, Russia was unexpected. I mean, well, I say unexpected from the Ukraine situation that's developed over the last 18 months, and unfortunate from the company's perspective, but clearly recovering. Oral tobacco continues to do well, but the group's performance hasn't been as impressive when it comes to their next generation products. And I think that's particularly when we've covered British American Tobacco. If you look at them side by side, next generation products, British American, particularly in the US, seem to be doing much better. Saying that, the net revenue growth was still decent in Europe on the next generation products. So, yeah, I think what we expected when we've covered this company in the past, we always say it, but it is at a depressed valuation. There's no signs of a re-rating. It's for, I suppose, what we've become used to, kind of obvious reasons in terms of environmental, social and governance issues, and it being widely considered an unethical sector. Therefore, a lot of institutions won't invest anymore. Certainly, shares are cheap, 6 times earnings for a big company as well, or 6 times forward earnings for a big company with a very big dividend yield that is pretty comfortably covered. It's still, churning out a huge amount of cash from the traditional part of the business, which is cigarette sales. Of course, we know that that's declining, and it's something that's in structural decline. The hopes, I guess, are pinned on the next generation products, so largely vaping and heat not burn. It depends what you think about that future, but some people might argue that you've got a very decent level of cash being returned to shareholders, both in the form of share buybacks and in terms of the dividends being distributed. So on a value basis, you wouldn't have to hold it for that long if it can, keep raising prices at least for another few years before you'd have your original investment back. But where growth comes from in the long term, I guess that depends what you think of the next generation products. And of course, you always have regulatory issues, and you see that in the US, particularly when it's coming to those next generation products and sales of flavored e-cigarettes, all very controversial. So that would need to be taken into account if you were looking at it from a longer term perspective and the future that it does or doesn't have ahead of it. And then, of course, you've got different policies around the world in sort of harm reduction and public health policies in relation to just the core business of regular tobacco sales, and whether they should be sold to 18-year-olds or essentially raising the age so no new 18-year-olds or generations going forward could be buying them, which is a policy that they've had in New Zealand. So there's a lot of that that anybody who is looking at this company would consider alongside the ethical issues. But Sam, what are your thoughts on Imperial and these most recent numbers?
I think, like you said, pretty much as expected. I think they're pretty decent considering just how much the Russian figures have made a dent. So I think they've done quite well to increase the underlying operating profit ever so slightly. It's very cheap. It's got a very good dividend. Ethical concerns aside, I think it's a decent business. The buybacks are good. But British American Tobacco is also a very cheap business. I'll just have a look at the PE of that. Yeah, British American is slightly more expensive. It's at a PE of just over 7, but it's come down quite a bit actually in the last year. It's down 20%. But I think in British American, you're getting a better business. I think it's better on the next generation side. These businesses are so cheap anyway that, if you're talking about the difference between paying 7 times earnings and 6 and having an 8% dividend or a 7% one, I'd probably pay slightly more for the better business in this scenario because it's still incredibly cheap. Don't really have much more to add other than that.
Yeah, and it's interesting when it came to the Russian issue but you had some companies, pulling out of Russia very quickly, and British American Tobacco and Imperial were slightly more delayed, presumably because they knew, how much sales were, or did contribute from Russia, and also maybe how much it would negatively impact on the brand, which, given that they're tobacco companies, probably less so than a company like Unilever, for example, that, prides itself on being very ESG. And saying that, we've seen that in the numbers, but yeah, it's just an additional point, I suppose.
They could have just left it and then just sort of adopted the view that their products were killing Russians. But I suspect if they'd carried on trying to operate, it would have been taken off them anyway. I don't know. They would have lost it one way or another.
Yeah, exactly. Jumped before they were pushed, sort of thing. Yeah.
At least then they can say, we did this on our own.
Yeah, they can go up in the ESG ratings. But anyway, yeah.
It's kind of like when a CEO resigns from a public company to spend more time with family.
Yeah, absolutely. Well, interestingly, British American Tobacco, their chief executive has stepped down. I'm not sure. I read it in the newspaper earlier in the week. I'm not entirely sure why that happened. He hadn't been there for all that long. So, yeah, I don't know. Maybe we should be following their results up pretty closely when they do come out. I don't know whether there's something going on behind the scenes, but that's just
I wouldn't worry too much.
Pure conjecture.
I think a donkey could run these businesses. I think it's just so easy. I think I could do it.
Okay, yeah. Well, you get paid an awful lot to do it.
Just stick with the buybacks, up the prices X% every year, like clockwork. Yeah.
I suppose you don't have like the branding as well. That's all disappeared too. So maybe you can do. I guess there's still the branding when it comes to the next generation products, but as they're not allowed to advertise in most countries now, that is not a concern. You don't really have to have a Don Draper to pay to design your latest advertising campaign.
I reckon I could do that job with 200 days holiday, yeah.
Well, yeah. I mean, you've just got a plain brown, murky-looking packet, and it's just what health warning goes on it, really. So, yeah.
But you don't even pick that. The government tells you.
The government tells you, yeah. So, I don't know.
Moving on.
Yeah.
So, we've got another debut on the show, Auction Technology Group. So I think you'll like this one, John. I don't know if you had a look at it beforehand.
Go on, Sam. Enlighten us.
So it's a FTSE 250 listed business. They operate 8 digital marketplaces in 2 major sectors. And basically what they operate is auction houses online. So they have 3,800 auction houses listed on their platforms. And they facilitated 74,000 auctions in the 2022 financial year with 7 million lots sold. They have bidders in 171 countries, 5 offices globally, and last year 103 million bids were placed. So in terms of their marketplaces, their brands include Proxibid, which is the largest online auction marketplace in North America, listing highly valued items across 16 categories, from agricultural machinery and yellow iron to classic cars and collectibles. You've got BidSpotter and BidSpotter UK, which are a leading marketplace for industrial machinery manufacturing and food processing equipment auctions. Got iBidder, which is the UK's leading auction marketplace for return and surplus consumer products. We've got the Sale Room, which I think you've been on, haven't you, John?
I have actually. I'm recognising quite a few of these brands. The Sale Room. It's antiques and sort of art markets in the UK. I don't know how much it extends abroad. I'm sure you.
So it does actually
seen those numbers.
It is Europe's leading marketplace for buying art, antiques, and collectibles.
Interesting.
And then I'll just see what else we've got. We've got Live Auctioneers, which is one of America's favourite destinations for fine and decorative art, antiques, vintage collectibles, and luxury goods. So those are the brands. And then in terms of their history, it's quite interesting. So they actually started in 1971 as Antiques Trade Gazette, which I suspect is why they've named themselves Auction Technology Group, so they can keep the ATG.
Yeah.
I'm sure that's deliberate. So then in 1998, they started listing auction calendars online, and in 2006 launched the first live bidding for art and antiques auctions on the Sale Room. 2007 launched iBidder. 2010 partnered with BidSpotter. 2013 acquired BidSpotter. And 2018 acquired Lottissimo, the leading art and antiques marketplace in Germany. Merged with Proxibid in 2020, which owns Auction Mobility, and listed in 2021. And they acquired Live Auctioneers in 2021 as well. So they have come out with their half-year results, and revenue was up 5% on an organic basis, but 17% on a reported basis to 67.3 million. And the reason was it was driven by a contribution from the acquisition of estatesales.net, and favourable movement in foreign exchange. Their operating profit was up 7% to 9.8 million. Operating margin was down 1% to 15%, which I think is fairly interesting because I think you would have thought this business would have a higher operating margin than 15%. Adjusted diluted earnings per share were up 19% to 16p. Adjusted net debt was up 10.3 million to 132.4 million, and cash generated from operations was up 11% to 24.6 million. They've said closing adjusted net debt of 132.4 was in line with the end of the 2022 year, as strong cash generation was offset by financing for the acquisition of ESN. Adjusted net debt over the last 12 months EBITDA gives a ratio of 2.3x. So that's not really at a concerning level. Gross merchandise value was 1.9 billion, up 5% on constant currency, driven by resilience in the auction market and continued structural shift online. Take rate was flat at 3.2%. So it says 3.2%, but that's because they've got industrial and commercial dragging it down a lot. That's got a much lower take rate, whereas art and antiques is higher, as you'd expect if you look at like Sotheby's margins or something like that. But that's got a commission rate of about 8%. But industrial and commercial, I guess there's lots of other places you can buy it, whereas art and antiques, if you've got the biggest platform, they do have to just take the price that you set. So take rate's 3.2% overall. They've said strong growth in value-added services were up 17% on a constant currency basis, benefiting from the strong uptake of paid-for marketing solutions. 83% of live auctioneers, US-based auctioneers, now onboarded on payments. They only have 3 full years figures out. However, those are from 2020 to 2022. And in those 3 years, revenue's gone from 35 to 119 million, and the operating profit has gone from a 5 million loss to a 17 million operating profit. Net interest has actually reduced. Earnings per share still a loss, but it's down from 34p to 5p a share. In terms of the valuation, well, there's no earnings, so we can't give it that. Market cap's 884 million, which isn't huge, and that works at 6.5x sales. If you were to take the annualized operating cash flow, so basically the 6 months in these results, and double it, you get 18 times the cash flow. However, that's operating cash flow, so would exclude the interest on the debt, which is fairly high. So you might end up getting somewhere like 30 times cash flow, but it's 30 times cash flow on a business that's basically tripled in the last 3 years. So I don't think it's outrageous, but then the organic growth this year is only 5%. I don't know that much about the auction market. You might know a little bit more, John, so I might be able to add to this. But I don't know. Organic growth of 5%, again, it's similar to what I was saying with Burberry. In a cost of living crisis, I don't know. I imagine that this is a somewhat cyclical industry, and that, for example, I imagine a good time to be in the auction business is when interest rates are incredibly low. I think people are more likely to buy silly things. It's probably the same for luxury cars and stuff like that. And that's just my intuition. It's not really backed up by anything. So if they've done 5%, this year, it might be that they get back to decent growth soon. What I do like about this is you lead it in the UK, Europe, and North America. The issue I've got is I don't really know how big the market could potentially be, because although it is the leader in all these markets, which is a big, big plus, it's a pretty niche market. Maybe they could get to the point, and as well, I don't know, like, are the biggest platforms, for example, Sotheby's, on there, or do they just say, no, we don't need you? I suspect the latter. But if you could get to a point where people just expect to be using you, and like Sotheby's and everyone has to come on, there's maybe a big opportunity there. But I don't think Sotheby's are ever going to struggle to sell their stuff. There was also some stuff in the slides I forgot to mention. So the adjusted free cash flow of 21.8 million is a 96% conversion rate. They've got 808,000 accounts, and that is up 8%. And they think that their online auctions result in 26% higher prices than when it's done in person.
I think that could well be true, in the sense that, it's not that I use the website personally, but some family members do. It almost acts like a portal. So if you were looking for, I don't know, a certain artist or a certain sort of object, you could search for it through the sale room, and then it might link you to different auction houses.
Right.
So ones that you would probably not otherwise have gone. So you might get a larger market, more competitive bidding in a sort of peripheral auction house. Okay, yeah, it's not like a Sotheby's or a Christie's, but it's those smaller ones that something, in the past might have not achieved its full value because the right people weren't in the room at the time. And when it's on a much smaller scale, that could obviously make a much bigger difference. So I wonder whether that's what they're sort of referring to, which I could well believe.
Okay, they've highlighted growing penetration as well. So the percentage of auctioneers using their marketing, they say, is up from 54 to 56%. So yeah, I like the business. I like that it's the market leader in probably the 3 biggest markets. I think you would think going forward that the online market share will continue to grow higher and higher. So they are probably positioned quite well. I struggle to value this though. I would probably keep an eye on it. Maybe I'll miss the opportunity with it, but I would keep an eye on it. I would definitely be up for covering it a few times again, maybe getting to know it a little bit better, but I don't mind sitting on the sidelines until I feel I understand the business a bit better. But I think it's interesting enough for the watch list. John, what are your thoughts?
Pretty similar. I would be sitting on the sidelines as well. I think it's interesting as a business how it's developed too, because it's very much like Auto Trader in some ways. That Auto Trader, it developed in the magazine. Same with this, with the Antiques Gazette. And then they've developed it into, well, we'll see how profitable it is in the future, but into it, this online sort of portal. Again, you don't know how big that market can be. Clearly, you're not talking about a company that's invented an online auction like eBay. It is sort of a niche product but it's largely for antiques and art.
Do you know if they have any kind of like verification process for the lots that are going on? Or do you think they do some kind of verification of the auctioneers that are listing?
I suspect they probably do more verification of the auctioneer's listing. I know that you can get in touch with the auction houses themselves and you could ask for, say, a condition report on different items. How user-friendly it is, again, I haven't really used it. I know relatives have, and I think it's reasonable.
I'm just thinking in terms of, is there any reason in terms of what they're actually doing where you couldn't look at that and say, these operating margins are 15%. I think they could be 60 plus in line with Auto Trader and Rightmove.
Yeah.
So if they're not having to handle or inspect the product, the operating margin seems incredibly low to me.
Yeah, and again, I don't know why that is, because as far as I would see it, it would be the auctioneers who have their valuers who would be doing everything in terms of, descriptions, uploading it, putting all of that sort of work into it, researching the item, verifying it, etc. And why the sale room or auction technology group would have it, be very involved in that and putting pressure on the margin, I don't know. So I'm not sure why it isn't a much higher figure, like you say.
That's interesting in that it'd be interesting to cover this for 2 or 3 quarters or 2 or 3 halves and see if that starts to tick up.
Yeah.
Because if it did, I'd probably be much more likely to pull the trigger, because I think if it were to start moving up, and as we carried on learning about the business, there's nothing obvious that meant they couldn't have Auto Trader or Rightmove like margins.
Yeah.
If you sort of had in your head where you thought they could get to, at that point, it would start to look very cheap.
Yeah. Absolutely.
But no, one to watch, I think. I'm sure it'll be back.
And again, it's a UK technology company, which is very interesting.
It is, yeah. So, should we move on to Britvic?
Yeah, so again, a completely different company, more in the vein of Imperial brands, but products are becoming healthier, actually. So soft drinks has brands like Tango, Robinson's, has a license for Pepsi in the UK. They had their half-year results out last week for the full 6 months to the 31st of March, with revenue up 7.9% to £794 million, and profit after tax up 21.4% to £54.4 million. The first quarter actually saw volumes fall 3.9%, but price rises meant that revenue grew 7.4%, and volumes rose 0.6%, with revenues up 8.4% in the second quarter. Tango sales were particularly strong with year-on-year growth of 56%, with 2 million new shoppers and the brand nearly doubling its market share. The group had a new sugar-free flavour innovation, and that, combined with some very successful marketing, really helped Tango. The PepsiCo brand portfolio, which Britvic has a license for in the UK, also performed well, with revenue up 9.2%. Another brand performing strongly was their mineral water, Ballygowan, which grew 34% year-on-year, with its new flavoured water gaining an 18% market share in its first year alone. Meanwhile, in Brazil, which is suffering from extreme inflation, the multiple price increases during 2022 fed through to correct the margin by 290 basis points. There were issues in the fruit processing business, which was impacted by poor crop yields and inflation. There's decent growth in brands like Fruit Shoot, which grew revenue 50%, and concentrated fruit juices up 26%. But overall volumes were down 7.4% and revenue was down 1.4%. Excluding derivative hedges, net debt stood at £615 million, which is around 2.2 times EBITDA and broadly flat. In terms of valuation, Britvic has a market cap of £2.4 billion and trades at around 17 times earnings, with a prospective dividend yield of 3%. I thought these results were pretty good, very similar to many of the consumer goods companies that we've covered in recent weeks. Things also seem to be improving again in the second quarter, which is good, handing on those price rises and again not seeing further volume drop. So all encouraging. It's got a strong portfolio of brands. I appreciate PepsiCo, it's on a license, but otherwise decent, very good with Tango. There were concerns about the soft drinks companies a few years ago when the sugar tax was introduced in the UK, but the brands have actually responded very well to that and innovated, and now they are selling reformulated drinks with lower sugar content, and it doesn't materially seem to be impacting on sales, which is very good for them. Brazil, disappointing. It'll be interesting to see the direction that goes in, because I think for Britvic, compared with some of its peers, that is the more attractive thing, that it's got potentially more growth ahead of it. And concerning to see that that's falling off, or has done in the last year or so. But that remains to be seen. And I guess when it comes to emerging markets, this is some of the volatility that you would expect, and it's supported by the more stable earnings that you get in the UK. Sam, what are your thoughts on Britvic and these latest numbers?
I thought they were quite disappointing. I know the profits are up and on the surface it looks quite good, but like you, I do find the Brazil results particularly disappointing. However, we've covered them for a couple of years and they've consistently been pretty good. So I'm quite happy to cut them a bit of slack, because like you say, you do, especially in emerging markets, you can have wobbles. But I think it's something to keep an eye on. Overall, assuming the Brazil figures aren't the start of a trend, I think it's got some solid brands. I like the emerging market exposure. I think at 17 times earnings with a 3% yield, it's not outrageously priced for the quality of the brands that you're getting. So I like it, but it would probably be, I'd be keeping more of an eye on it, I think. In terms of those Brazil results, I'd want to see them turned around in the next probably year or so.
Fine. And what do you think of it compared with AG Bar, for example? Because I know we've covered that quite a few times.
What's the valuation of AG Bar at the minute? Not that it's going to particularly affect my answer.
Okay. It's basically the same. 17 times.
Yeah, I think Britvic's got the better brands. AG Bar's got some decent brands. It's all right, but I don't know why you'd pick AG Bar over Britvic when they're the same price.
Yeah. No, that's interesting. I didn't expect that, actually. I thought
they're always fairly similar, but I think normally it's like, Britvic might be 17 and AG Bar's maybe 15 or something.
Yeah, similar with British American and Imperial.
Yeah, but I just think when you look at the AG Bar brands and you take away Iron Brew, there's a couple of ones but it's definitely, it's not the same as like Britvic. You can take out 2 or 3 of their top brands and there'll still be 4 or 5 that you recognise, whereas AG Bar I don't think quite has that.
Yeah, they've got a few more speculative ones like MoMA.
Yeah,
That was,
and they've got the Funkin' Cocktails one as
yeah,
well.
that's quite a good one too. Yeah.
Right, should we
Okay.
move on to PayPal?
Yeah. How are they doing?
I thought they were doing all right. The market disagreed. That's life. So PayPal, which I am a shareholder of, have come out with their first quarter earnings. And for the first quarter, net revenues were up 10% to $7 billion, ignoring exchange rate movement. Revenue growth was driven by a 12% increase in total payment volume to $354.5 billion. Underlying operating profit expanded faster than revenue, up 19% to $1.6 billion. That's a margin of 22.7%, which was ahead of guidance. However, it's slightly lower than the previous year. Non-transactional expenses, such as marketing and operations, were down around 12%, but margins on transactions were the lowest seen in the last 6 quarters, reflecting a shift in the product in the mix towards lower margin unbranded processing. So currently the strongest volume growth is coming from the unbranded business, which allows businesses to put their own name on the payment solution. So you basically don't know you're using a PayPal product. Free cash flow is down by 3% to $1 billion. And all these figures in dollars, I should have mentioned, reflecting an increase in tax payments. PayPal bought 1.4 billion of its own shares in the quarter, with about 4 billion expected across the year. And that's on a market cap of 70 billion. So that's, what's that, like about 6% a year. And they did, where was it? They did the similar amount last year. They did 4.2 billion last year. So that share count's coming down by probably 5 or 6% a year. Net cash stood at 179 million, down from 451 million. However, it is coming in like clockwork, so they don't really need to hold loads of it. Second quarter revenue is expected to grow between 7.5% to 8%. For the full year, underlying earnings per share guidance has been raised slightly to about $4.95. That's on a share price of $61. Underlying operating margin growth guidance now points to an expansion of at least 1 percentage point. Shares fell 12.7% the day these results came out. PayPal is processing 5 times the value of payments it was back in 2015. And last year, the free cash flow was over $5 billion. In terms of valuation, the business trades at a forward PE ratio of 12.8. And then the average since it listed, when it was spun off from eBay, was 31.2. It doesn't pay a dividend. However, you are getting about 5 or 6% back via buybacks every year, which if you are in the UK is actually better because you don't have to pay any withholding tax. So I'm pretty happy with it. And as well, it is really cheap at the minute. So I've got no issue with them buying back stock. I'm very happy with these results. I do find the valuation baffling. I understand that people are concerned that like revenue growth is slowing, but it's still putting up decent figures. And it is a huge business. This isn't, you can't, I think it's almost like Amazon and Apple have accustomed people to thinking that these businesses will just, trees will grow to the sky. It's not normal what some of these US businesses are doing. And typically, as a business gets bigger, growth does slow. That is just the reality. And they're still putting up decent figures. They're cutting down on costs. I think they've still got a lot of avenues to play with in terms of growth. Yes, it might be slower, but at 12 times earnings, what do you care? And the quality of the business as well that you're getting for 12 times earnings. I mean, some of the other businesses you might have to look at in America that are trading at 12 times earnings, or even in the UK, it's, comparable businesses at this level are just nowhere near the quality. I find it absolutely bizarre to the point where it makes me wonder if there's something that I'm missing with it.
Yeah, that was what I was going to ask you. What do you think accounts for? I appreciate the numbers aren't what they used to be, but obviously this is reflected in the valuation. Why do you think it's quite so cheap?
Well, firstly, it was extremely expensive. So it's come down about just get it up. I think it's come down 80% from its high. It's come down a lot. Yes, it was about $300 a share at one point, and it's now 61. So you're down 80%. So the only other thing I've seen, which I hadn't mentioned, but I think Apple Pay's market share is growing. So I think the concern is that, Apple Pay and Google Pay, because everything's being done on mobile, a lot of stuff is going to be taken off PayPal because people will just go straight to that.
Yeah.
I don't know. At the minute, it's not. Although the growth is slowing, they're not losing sales. I suspect Apple and Google Pay are going to take market share off everyone, but I think PayPal's still going to do very well. I've got a PayPal account. I've started using Google Pay more.
Yeah.
But
I was about to say I use Apple over the last 2 years, increasingly I'm seeing in sort of online checkouts, it's pay with Apple Pay. And on the iPhone, it's a couple of clicks, scans your face, linked with your credit card, and that's it. So I wonder,
I am still using PayPal though. It's not gone to zero, but I am using Google Pay more. But I don't think it is going to go to zero. I think there's other avenues they can use to expand revenue. I think there's other stuff they can do with the apps. They've got lots of different offerings. And you know what? I think at 12 times earnings, I'm quite happy to take the risk that it is a zero, because it's incredibly cheap for the quality of the business. What are your thoughts on the results in the business?
For the valuation, they seem pretty decent. I'm a little bit like, well, you're obviously not where you bought the shares in it, but I would worry about perhaps the sort of Apple, the Google, why it is quite so cheap. Is that just the market overreacting, or is there something that I'm overlooking? Is it that threat from Google and Apple in terms of the payments market? Maybe that PayPal is also going to have to look in newer avenues that are less profitable. I'd want to dig into it more, but on the surface, at least, it seems very good value. But I'd want to make sure that I'm not missing something that underlies or undermines rather the fundamental investment case. I think that would be my main concern.
So, of the 6 businesses we've covered this week, Burberry, SCS, Imperial Brands, Auction Technology Group, Britvic, and PayPal. If you had to buy one, which one would it be? And then also, which one would be your last choice? With
my own money, it would probably be Burberry, I think. If it was more speculative, Auction Technology Group. But really, I think that's going to be, from a serious investing point of view, it's going to be one to watch. I'm certainly not ready to pull the trigger on that. I need to do a lot more research into it, but it's quite exciting as a British tech company.
Which one would be last?
Oh, sorry.
Yeah, it's a new this week. So we've been asked by a listener to start doing that one as well.
I would probably say SCS. And it's, very small cap. And I know it's cheap, but I wouldn't be, I think, comfortable investing in a company like that.
So I think for me, first choice would be PayPal, which I'm pleased with, given that it's the only one that I own. But I do think it's cheap, and I've looked at it a few times, obviously, because I've bought it. But I can't. I think it's the Apple Pay increase in market share. I think that's what's really hammering it. But at 12 times earnings, I'm quite happy to take the risk, especially with those buybacks. Least would... I think I might go with Burberry, actually.
Oh, really?
I think I'd rather pay 4.5 times earnings for SCS than 19 for Burberry. I just think for the figures it's putting up, I just thought it was a bit more so-so. Whereas like SCS, for the valuation, I thought they were pretty decent results. But SCS really, its main fault is just it's not the sort of business I would normally like.
Yeah.
Whereas Burberry, I just think it's expensive for the figures it's putting up.
Yeah, I suppose it is on the basis of the luxury brand, but then also that it's got China and people like it, really value that brand there, and the longer term growth. But I appreciate it's underwhelmed over a number of years.
Yeah, which is my concern, because I just, again, like in a year or two, if those growth figures haven't picked up, I think it's quite expensive at 19 times earnings, whereas at 4.5, SCS has much less room to fall. Right, I think that's everything in that case.
Thank you very much for listening, and see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.